The Arizona desert has become one of America's most dynamic real estate markets. Today on RipplEffekt, we examine Phoenix's commercial landscape as it navigates a stable rate environment and sustained housing momentum. What's driving opportunity in the Valley of the Sun? Let's find out. Phoenix continues to attract capital and residents at a measured pace. The metropolitan area is benefiting from a confluence of factors: modest inflation running at 3.4% year-over-year, a labor market with unemployment holding at 4.2%, and consistent housing formation. Housing starts in the region reached 1,427 units, a figure that reflects both pent-up demand and developer confidence. The 30-year mortgage rate sits at 6.55%, down from peaks we saw earlier in the cycle but still elevated relative to the pre-pandemic baseline. What matters for commercial investors is clarity. This is neither a heated market nor a cooling one. It is stabilizing. Let's drill into the numbers that matter most for your investment thesis. The 30-year mortgage rate at 6.55% remains a significant input for residential valuations and cross-collateral structures in mixed-use developments. The Fed funds rate estimate of 5.33% tells us we are in the later innings of this tightening cycle. Year-over-year inflation at 3.4% is moving in the right direction, closer to the Federal Reserve's target, which removes downward pressure on asset prices. The unemployment rate of 4.2% is a crucial metric. It indicates that tenant credit fundamentals remain solid. Companies are still hiring. The trend line in Phoenix is one of gradual normalization after several years of volatility. First, demographic tailwinds remain real. Migration to Arizona has slowed from pandemic peaks, but it has not reversed. Population growth, though more modest than 2020 to 2023, continues. Second, rental and leasing markets are showing resilience without exuberance. Landlords have pricing power, but it is not aggressive. That equilibrium attracts institutional capital. Third, the rate environment is shifting. RipplEffekt has identified 3 curated opportunities in the Phoenix market deserving of your attention. Our first selection, 150 East Mino Cove in Roosevelt, Arizona. This is a mobile home asset listed at $189,900. 3 bedrooms, 1.5 baths, 1,120 square feet. The price per square foot stands at $170, which represents a 41% discount to the ZIP median, a significant value play for investors focused on affordable housing segments or portfolio diversification. The property has spent 519 days on market, which suggests pricing opportunity for the informed buyer. Phoenix remains a market of measured opportunity for investors with patience and discipline. The macro backdrop is supportive. Unemployment is stable. Inflation is declining. The Fed is poised to ease. And the rate environment, though still elevated, is trending in the right direction. That combination does not produce overnight windfalls. It produces long-term value. If you are analyzing the Phoenix market, whether you are chasing value-add office, industrial land, mixed-use development, or residential play, RipplEffekt is your institutional intelligence partner. Visit us at RipplEffekt.com for the full intelligence brief.